Good morning, everybody, and welcome to the ARMR Report. Thank you for sharing some time on your weekend with me. I'm Brett Rosenthal, and the ARMR Report today, as it does every weekend, is going to go over some of the basic big picture macro themes of how we're running capital. We're going to focus on things like precious metals, gold, and silver. I'll throw a little Bitcoin in because I know you guys are excited. We're going to talk about our risk monitor and how we're structuring our portfolios and sharing that information with you. We're going to highlight one of our favorite technical tools called the Fibnonacci Fan. I'm going to show you how it works. And really, we'll discuss real quick why it's so accurate. The deep dive today was supposed to be me and the Silver Fox sitting down, drilling into, pun intended, our precious metals positions. Woke up this morning, Silver Fox unwell. He'll be with us next week. Apparently some fishy tuna. Not well. So we wish him the best. I'm sure he'll be back up on his feet in no time. And we'll move this. We'll do this entire show redux next Saturday. Deep dive, me and the Silver Fox, an ARMR insider we all know and love. Literally. And we'll go into the intricacies of Basel III and the changes that have occurred in the precious metal space that we believe are leading to not only outperformance to start the year, but really a dominant theme for us at the ARMR Report, for now and into the future. Okay. So we're going to break down and do a deep dive next weekend. So for today, you've just got me. Let's dive in together, go through these steps of how we run capital at the ARMR Report. Fill in, if you'd like, your questions, your comments in the comment section, and I'll get to all those Q&A questions after we break down the ARMR Report step by step. So as always, I call it a virtual hedge fund. I'm running capital. I'm sharing with you the information that's derived from 30 plus years of experience doing this, talking to management teams, gathering and pulling out information that's valuable, helps us make money. And we couple that with an algorithmic execution strategy. When you put those two things together, when you put yourself on the right side of probabilities, when reward is worth risk, and you do it over and over, net worth can grow and you can protect capital in a bad market. That's what we do here. If you want to be an ARMR insider, right there, armorreport.com, or what is it over here? Over there, armorreport.com, ARMRreport.com. You can also subscribe to our free email alert. Comes every Sunday in your mailbox, so you're ready for the week. And we break down for you actions we took the prior week and thoughts about what we may be doing going forward. It's free. Go to our website, armorreport.com, and you can subscribe to that. All right, let's dive in. Let's dive in first with this picture because I just think it's so sexy. That's a chart pattern of the weekly chart of Sprott physical gold. And we're going to get to that in a minute. Because what I really want to do is walk through step by step how we run capital at our virtual hedge fund. And this is how I order my thinking. So step one for us is, what is the risk monitor telling us? The risk monitor is the driving force, our algorithms geared towards the top indexes. We're going to go through each one so you can see why the risk monitor changed yellow last week and why we have approximately 70 to 75% of our capital committed to the market. And we're going to carry 25 to 30% cash in the average ARMR portfolio. We're going to use that cash for day trading. I'll walk you through what that looked like this week and how we're executing there. So let's start there and take a look at a couple of the charts. And we're looking at the weekly charts right now. I always say the end of the week is so much more important than what goes on during the week. And so what you see here in the Dow, which is a leading index, is a rip off the low, a pullback to test the 50-day, and then 2 strong weeks. Okay, I want you to note that we're not above the high of this big down reversal bar. The risk monitor is yellow because not all of our index algos are telling us the same thing at the same time. That confluence that turns the risk monitor green is when we have the highest probability of success and the reward's worth the risk. And so we'll have maximum exposure in our portfolio. If it's yellow, what we're getting are kind of cross currents. Some indexes look good, some indexes not so good. Some index algos giving us the risk on entry, some not. So we can't get to green. The green is really proof that institutions are moving in mass to put capital to work. And that's when the individual, you and me, want to step in and have our biggest exposure, because information makes money, but institutions make markets. So the entire ARMR report, the whole point of what we're doing here and using algos to do it, is to identify when the institutional elephants are charging and making sure as a cheetah, we're not getting stepped on and we're out in front of them. That's what we're doing. Okay. So step one today, risk monitor yellow. Okay. Risk monitor yellow. And I'll just run through a couple of weekly charts. I want you to see one thing. So here are the indexes we follow. The Dow looks great. The IBD 50 looks god awful. That's one of the 7 indexes. Okay, small cap index. Coming off of the lows, had a decent week, had a real decent week, but no entry point for us. Momentum index. We're long momentum, didn't really confirm at all. Couldn't get above the 50-day moving at, well, there's a 50-week moving average here. It's above the 50-day. NASDAQ 100, we got that risk on entry point here. As you can see, it's wildly underperforming all the other indexes with the exception of the IBD 50. I want you to see all these. This is, by the way, we've incorporated now. This is very interesting and I think very important. We're starting to incorporate the equal weighted NASDAQ 100 and the equal weighted S&P 500 because they're telling a different story that's much more bullish. This would be a weekly reverse head and shoulders pattern. And if we can get above this black line here, take out really this tail high, but I would say right in here, if we could take out this level right here next week, that would be confirmation that there's a real move unfolding in the market. That white line, we could take that out, the neckline, that would be real bullish. Now here's the real confusing piece. Our algo on the S&P refuses to go green. Totally missed the window. And as you can see, it's trading between these 3 yellow lines, which are all Fed days. The white boxes are the Fed days, okay? And I'm just pointing them out. You can't see them right here because this is a weekly chart and they're on the daily. But these are the Fed day lows that were most important last year. And the market just keeps bouncing around in that range. So our algorithm is not giving us the risk on entry point. And you can see why. The S&P hasn't really gone anywhere. It's just bouncing around inside of a range. It's really in no man's land. It's not down here where we had risk on green down here and we captured that move last year. It's in no man's land. But look at the equally weighted index. That is compelling. The equally weighted index broke out last week and the risk monitor went green. I should say the algo for this particular index went green the prior week. So this speaks to breadth. This speaks to the fact that the big names are suffering, but on a whole, the 500 names equally weighted are breaking out. So now you understand why the risk monitor is yellow. It's really in those 2 charts. The big index with the weighted names like, and we'll just take a quick look at a couple, right? Tesla looks god awful. Apple suffering near the lows. Microsoft, classic head and shoulders top breakout, looks terrible. Maybe it's making a double bottom, who knows, but it hasn't come out of that. Okay? Match those big names off of the S&P 500 equal weighting, which is breaking out. And in a microcosm, that explains why the risk monitor is now yellow. So what does that mean for portfolio management? The ARMR Report, we're always trying to cut through the noise and just give you the facts to help you protect capital, capture upside. That's it. So let's condense everything I just said. When the risk monitor is yellow, it means we're able to take risk. We want to overweight the portfolio where we see alpha. We'll get to that in a minute. What is our macro theme? We're going to talk about that in a second, because that's where we have the majority of our investments at the ARMR Report. And it's producing alpha. Our portfolio's outperforming the indexes. Okay? The first 2 weeks of the year. We're going to go over why. But when the risk monitor goes from red to yellow, it means we put capital to work in a focused way. We don't carry indexes for swing trading reasons overnight. We hold cash in our portfolio. There's a cash allotment we're not putting to work. And we use that to day trade the indexes to capture index performance without the risk of overnight dislocations. That's what risk monitor yellow means. Okay. So now let's flip real quick over to how, what is the focus? The macro focus for us, and we did this, we talked about this, the ARMR Insiders last week, we did our macro meeting. The macro focus is US dollar weakness all year. So let's go back to the charts. Okay, we think this is going to play out all year. We called this double top, if I may, in all humility, which really means I'm lacking in humility at the moment. I totally called this top, right? I highlighted this to you guys last year. I said, that's the top in the dollar. And if it is, we want to overweight our portfolio commodities as it's going to lead, particularly gold and silver. And we added platinum, and we have uranium, and we have copper, and we have natural resources and oil and gas. We added rare earths last week. So we're filling out our portfolio focused on the breakdown in this chart. I said to you last year, if you were part of this, following this channel, I appreciate if you did and you're still with me. I said last year that was a historic move in the US dollar. I don't think we've ever seen it before, that type of move in the dollar. And I don't think we're ever going to see it again. And I think it has to completely unwind. And that's what's going on right now. And as it unwinds, this is the simple understanding. This is the easiest way to understand the macro theme that we're executing at the ARMR Report. As it unwinds, it releases asset prices, particularly commodities, to go through the roof. Okay? So our focus is on commodity-driven emerging markets. Is going to work. Let's take a look at emerging markets. Okay? Here's an emerging market. Look at the emerging market breakout. It's a weekly chart of the emerging markets. It's the reciprocal of the US dollar, as you can see. There is tremendous upside simply in the US dollar going back to equilibrium. Normally, these pendulums swing, right? So when it gets out of hand on the upside like it did last year, I would expect the dollar to get out of hand on the downside. This should make for a multi-year move in commodities, emerging markets. I'm going to talk about Bitcoin in a minute. Let's don't confuse Bitcoin with commodities or an inverse play on the dollar. We'll get to that in a minute. We're going to look at charts. Okay. So to wrap up this thought and what we're talking about right now, right here is our portfolio focus. Our portfolio is focused on the following charts. I'm just going to run you through these weekly patterns so you can see what we've added to our portfolio. And I'm going to end on gold and silver because that's going to be our research focus today. So let's just rip through some of these ETFs, okay? you're going to see a lot of the Fibonacci fan, and I'm going to highlight what this means and how it works as we go forward. We're on the copper ETF. Copper's breaking out. Is it COPR? What is the what's the copper TPER? There's a copper. There it is, copper index. This is copper futures. That just blew out. Copper futures. Now, but before I run through this, let me explain another thing about risk monitor yellow to me. There is a lot of risk in this market. Just because we're making money in the first couple of weeks of the year, which is great, what risk monitor yellow tells us is the market is not stable. We're not in a green scenario, grind higher, Fed induced, Fed supported bull market that makes us all a fortune. That is not what we're in. And I want to caution right now, the party hats should not be on. I see you in the back. You got a party hat on. Take it off. Take that hat off. The market is not about to rip higher at the moment. It may confirm it next week. Let's take a look. But what I want you just to jump back into the charts a minute of the indexes, okay? The indexes have not broken out yet. The S&P is in no man's land, okay? The S&P 500, which is equally weighted, is trying to break out, but is yet to take out these highs. The Dow, which is the strongest index, is yet to take out these highs. And if we drill down into the daily now for the Dow, this is concerning to me. This big breakdown on volume is not usually erased in a pattern like this. Now, I'm executing a strategy, but I wanted to throw out there caution. Yellow is for caution. That pattern is not a healthy pattern on the Dow. Could it blow out? It could, and I hope it does, man, because I'm making money in this market. So I'm a bull. Please, let's blow out. But that pattern is a dangerous pattern. It's a big volume breakdown, found support, running up into the overhead. If it can't get above the previous highs and it rolls over again, the market's going to get ugly in a hurry and the risk monitor will go back to red. So that's the cautionary comment I want to say before I go through the rest of our portfolio. Okay? You want to join us on the desk, armrreport.com, right there. Become an ARMR insider, and you'll know how we're executing during the week if we get those types of exits where we have to protect capital. Okay? But anyway, getting back to more fun things to talk about, and I really want to look at the weekly because weekly charts are so important. We're on copper. We're on natural resources. First Trust actually has a pretty stout dividend payout, which is kind of interesting. FTRI. This is not fair to look back and say you can expect this because this is a 8% yield, okay? The top three names in First Trust are BHP, Rio, and Valley. They have a habit of paying out high dividends when asset prices go up and they're making a lot of money and they pay out a lot to shareholders. Asset prices go down, the dividend's different. So you can't guarantee an 8%. But assuming asset prices go in the direction we think, this is a very compelling investment for a conservative portfolio who wants to collect dividend yield. Okay? So there's First Trust. And you can see this just breaking out, but huge volume last week. Let's move on to, we added some last week, rare earths. Just started. Hadn't even moved yet. In fact, that chart's not that attractive, right? It has to get above the downtrend before it really takes off. These are more thin stocks, a little more dangerous. Things like MP that are just coming off the bottom. Things like lithium, which are just coming off the bottom. So we're early on REMX. Okay. Some uranium. That is making a huge pennant. We bought it prior week in here. It popped up this week, which is great. So we're buying it right close to the bottom, right close to our stop. and we're looking for uranium to take off. And we added some shares of XOP at the end of the week last week. XOP is lagging behind its two companions, XLE. So XOP is exploration and production, primarily U.S. XLE is international, big guys. And OIH is your service stocks that are really blowing out. Okay. I want to throw in there just a couple, which is interesting. I threw in there biotech at the end of the week, because if the market is going to go higher in here, we already have at the ARMR Report more than 50% of our portfolio in commodities, and we did that 2 weeks ago. Even more than that, we started doing that back in November, and I'm going to go over gold next. We're going to talk about gold and Bitcoin in a second. Okay, gold, silver, platinum, and Bitcoin. So we already built up our commodities side of our portfolio. I'm max invested there. 50% is enough. I'm probably around 55%, maybe 60. Okay. That's it. Any incremental dollars, I'm focused on the leadership sector in something like the NASDAQ 100, which are biotech stocks. And you can see why right here. This is a beautiful bottom forming in XBI, S&P biotech sector. And then, of course, you can go with the big cap names in IBB, which looks even stronger. I mean, that's even stronger. Okay, so we're right in there, green. And we focus on these groups just to be clear. Whoops. Oh, my God. I hope that wasn't a Freudian slip. All right. We focus on these sectors because we use ARMR algorithms to execute. So we do our macro meeting. We figure out where we want to go. We go through our list of ETFs. We use our algo to tell us which ones are giving us entry points. We buy as close to the stop as we can, make our investment, and manage the risk on the way up. Okay, which means booking profits at targets, raising stops, and then letting it go and see how much money we can make. That's the ARMR way. All right. So that's our portfolio right now. Let's dive into ARMR research. While you all are here to begin with, and the Silver Fox will be here next week, assuming he's feeling better. He was up all night, not doing well. You gotta love the guy. He wanted to come on anyways. Like, I'll be there. I'll come on. I'll do it. I said, Bob, it's okay. It's okay. Everyone will come back and meet us again next weekend. So just so you know, he was wanting to lay it all on the field. And I love him for that. So let's go now into precious metals and a quick review of our original entry point. Okay. The ARMR Report started to buy precious metals, gold and silver, down here where this little 2 is. And I'm going to drill down now into the daily chart pattern so you can see. Okay. So right here, right in here, that's when we first started to buy gold as it broke this second downtrend line. And I'll go over that in a minute. Okay. Then we loaded up on precious metals 2 weeks ago on our mining stocks right in here. And I told you guys that last week. And you can see how it performed this week, going out right at the highs. Okay. So it's just really getting started. While we were doing gold, we were also buying silver. Look at that weekly chart of gold. It's a runaway. Let's go back and look at the weekly chart of gold because it's just like the sexiest chart I can find. 3 gap up weeks running away, the price of gold, running away. But it's a barbarous relic, right? Nobody cares about it anymore. Oh, I love it. I love it. Okay? When Twitter starts tweeting about how great gold is, you and I are going to be selling some. Right into that, right? But right now, what I hear on Twitter are the Twitter gremlins coming out and telling me I should be buying Bitcoin because it's above 20,000. It's starting. It's going to go to 100,000 this year. It's going to go to 2 million in a couple years. I even have some jokers telling me that Bitcoin He's going to balance the budget, right? We have a debt ceiling issue. Please. It's never an issue. It's always resolved. Debt ceiling gets lifted, blah, blah, blah. There are actually people talking about, to me, direct messages on Twitter telling me that Bitcoin's the answer to balance the budget. Bitcoin, guys, let me just be clear. I think you all know this, but let's just be clear. Okay. Bitcoin doesn't even, it's not even an argument. It doesn't have the market cap to be able, it doesn't have the size. There's no institution, there's no central bank or institution that owns Bitcoin in any type of size. There's no government that owns Bitcoin in any type of size to balance any budget. So let's, like, what I can't believe is that the snake oil salesmen come out the minute Bitcoin goes up. So please think clearly before you run into Bitcoin. And instead of arguing, this is not an argument. I don't want it to become an argument. It's not an argument about the philosophy behind cryptocurrencies or any of those things. I'm sure crypto has a space, okay? It's not a debate here about that. It's just simple fact of technical analysis and market cap size. Just recognize cryptocurrency. This is all I'm going to say about crypto. Recognize what they are. Cryptocurrencies and the miners, okay? They are high-risk assets that only go up when there's a market rally. That's it. They're not some panacea. Not now. They may be, I don't know, 5, 10 years from now, I don't know. But now, they're a risk-on asset. That argument should be clear to anybody trading this thing, as they got absolutely destroyed in the bear market. So now the market starts to rally. I'll tell you what I love about crypto. What I love about crypto this week is that it confirms the market rally. If crypto can pop like this, then money's coming back into risk assets, and that confirms our risk monitor change from red to yellow. That's great. But look at the chart for a minute before you get carried away with Bitcoin going to 100,000 next week. Okay. Let's look at gold and let's look at Bitcoin. I'm going to zoom in here and I'm going to scooch over real quick to what I call ARMR education for today. And that's the Fibonacci Fan feature that I absolutely adore. You hear me talk about it a lot. I want to go through it real quick. It's pretty easy. The Fibonacci Fan, Fibonacci sequence. You don't need me to explain that. If you don't understand what that means, feel free, when this is over, to Google Fibonacci sequence, and it'll explain to you the bizarre and beautiful process in nature where you will find the Fibonacci sequence. The fact that it plays out in all types of nature really applies itself to technical analysis of equities trading or any type of trading, because it's human nature that creates these chart patterns. Don't forget what chart patterns are. They're just showing you graphical representation of the war between buyer and seller. That's what these charts are. Sometimes I think we get lost in, what it all means, or what else. It's a pretty picture, the red and the blue and what blah, 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 moving averages. But what it really is a graphic representation of the war that's going on between buyers and sellers. And we draw these trend lines and we draw these Fibonacci fans and we look at moving averages, because these are the lines in the sand where the armies get face off. And if the buyers overrun the sellers run for the hills looking for the next, cache of ammunition, and the buyers race towards them, right? That's what's happening, right? So we look at these levels to see, okay, when are the buyers going to take over, or when are the sellers taking over? And the buyers are panicking. That's all the technical analysis is. And it's a wonderful tool, and Fibonacci sequences are one of my favorites. So this is a simple sequence. It's using Fibonacci Fan to draw 3 downtrend lines. And the theory is, when the third line is broken, a change in trend has occurred. Until the third line breaks, you're still within that primary trend. Nothing's really happened except for normal volatility in the downtrend. But when you break that third trend, a new trend is formed, and usually that's an uptrend. I mean, it could be sideways action, but usually it's an uptrend. This is a beautiful example on a weekly level of how the Fibonacci fan works. Here's gold selling off. The yellow line connects the initial rally up, right? And then you can see gold just follow the yellow line down. Then it breaks that yellow line. That's one. Goes up to the blue line, takes a couple of weeks, breaks the blue line. That's two. And we were buying gold right there when it broke the second Fibonacci line. That was early. We bought it early. What you really want to do is make sure you're on board when you break the third trend line, which was 3. And that's what we talked about a while. We've been walking you through this process. And you can see what it does when you break the third trend. It then accelerates higher. This is like hockey stick type acceleration right now in gold. Let's go look at Bitcoin. Okay, there's Bitcoin. And this is just since BITO I'm looking at the ETF BITO. So you can go back further looking at Bitcoin, but this is an easy way to do it. So there's the big line in the sand, that red line. And Bitcoin has been fighting that line going back to, what is this? June, right? So above the line and below the line, and we popped above it. We haven't even taken out the high of that bar, right? So before I would break out the party hats, I would say, I'm willing to say this. Look, I'm not a bear on Bitcoin. I'm happy to get long Bitcoin, okay? But I think it's a little bit early to get excited about it. That's what my comment is on Bitcoin this morning. Just everybody just rein it in a little bit, okay? There's a lot of risk out there. So there's your green bar. It broke the second fib line, right? It broke the first fib line, just broke back down. But now it comes out. So we have to see if it can build on that. And quite frankly, it needs to break the third trend line. And my guess is because of the unbelievable ass kicking, and that's a technical term, that crypto has taken, there's huge amounts of overhead in Bitcoin and all other cryptocurrencies. Overhead meaning people are trapped at higher prices. Don't believe the guys that tell you this is the beginning of the greatest thing ever, blah, blah, blah. They're just hoping they can talk it up so they can dump their Bitcoin. I guarantee it. Okay? Don't get caught in that. Typically, when an asset gets destroyed to that degree, it takes time to break that third Fibonacci extension. Fibonacci trend line. It takes time. You have to get far enough into the cycle to get rid of all those holders that are trapped at higher prices. And then you break that trend line. So I'm interested in Bitcoin. If it can get above that trend line, I'm happy to get involved. But I'm not buying it down here, not yet. The focus and the way to put money to work, you can see, and it's really hard to argue it, is to pick off gold in here and then enjoy the rip here. And while everyone else is paying up for it, I'm already making money. I'm not buying it up here, right? Okay. So thought I'd just run through a couple fib fans just to see you can see what I'm talking about. Let's do it on a daily chart too. Oh, there's too many lines here. There's a long-term fib fan and a short-term one. So I was just showing you both here, but we could take this one off on copper and you could see how it works. The first place to buy copper was down here. Whoops. Right? That was the first spot. As it broke the first level. Then it went through 2 levels at once and then came out right here. That was the second spot, right in that formation as it broke the third downtrend line. Of course, copper is skyrocketing. And we can run over to silver real quick. And you'll get the same stair-step approach. And you can see where, of course, we were talking about it here. We were buying silver here. Now it's breaking the third downtrend here. Now, while it's running up here, I'm not a buyer up here. I already own it down here. using the Fibonacci Fan sequence as a way to enter. All right. So to wrap up, these are my thoughts, and I'll get to your Q&A now. Risk monitor turned yellow. It means we're putting capital to work. We've already put capital to work, so we finished off our exposure. We're going to carry a cash position, let's say somewhere around 30%, which we're not going to commit. We're going to hold that overnight, and we use that to day trade. We're focused on commodities. We're focused on assets that benefit from US dollar weakness. We recognize that risks are elevated. And while the market had a decent week, it has not broken out above key levels. Everyone keeps pointing to the market might be above the 50-day or the 200-day. That's not enough. There's key lines in the sand. The market's still below. So next week is an important week. If we can get above those levels, hey, we'll be cooking with grease and having a great January. And that would be great. But caution is still the word, and a focus on US dollar weakness is where, in our opinion, portfolios should be allocated. All right. So without further ado, let's jump into your Q&A, and I'm happy to answer anything you got. Michelle. Hey, Shell. Nice to see you. All right. Comments on GNT and GGN. GNT and GGN. Festeroso, how are you doing, my brother? I don't know these, so I'm going to pull them up here first. Closed-end fund, gold and silver. I don't have an opinion on that. I can look into it. It's got a 7% yield. You know, no alpha to add for you there. These are closed-end funds investing in natural resources. Well, let me say this, Festeroso. You already know where I'm putting capital, and we've already put that capital work at lower prices in those types of assets. If you owned them, great. I mean, they're right in that macro theme. So have at it. I don't have anything negative to say. When I look at those charts, I'm not a buyer up here, right? At the ARMR Report, we've already put our commodity allocation in the portfolio starting in November and increasing it dramatically at the start of this year. So now we're letting everybody else mark up our portfolio, and we're just enjoying the ride. So, and I think I said last week, which was the first week of the new year, was the last week that I was willing to put any money to work in gold and silver plays. We were already in, and now I just want them to mark up our portfolio, and I'm not chasing from here. Hey, Erez, nice to see you, man. Thanks for joining. Time to buy Moo. It's an interesting idea. Agricultural business. Let's take a look at that's an interesting idea. You know, but inside of FTRI, Erez, is, you know, some of the agricultural names like Archer, Daniels, Midland. Those charts don't look so good. I don't know exactly why the stocks don't look so good. But, you know, there's Bunge and ADM are the best couple of names. I know you're on the egg play, right? You're buying shares of Vital Farms, which looks like, you know, that's a great looking chart pattern. I can't wrap my head around. We listened to that conference call together. I don't know why anyone's paying for premium eggs in a market where egg prices have gone berserk. I mean, I don't know. But anyway, there's a chart pattern that looks great, and Moo is certainly something we can look at, Eris. Little royalty play looking good. EMX. I'm going to write down my favorite part of the ARMR Report. The the weekend ARMR report because I get some great ideas from you guys. So I'm going to write down Moo. I really want to look at that. Canadian-based company engaged in acquisition. Oh, gold and silver. All right. Look, Aries, let's bring this to the table again next week. Silver Fox will be here next week. Assuming he's feeling better, I think he will be. And we'll go over some of these, some of these other names. But certainly something we can look at together on the desk, Aries, this week. Look at that chart. Look at the weekly chart on EMX. God, that chart looks good, Aries. Man, I got to write that down. ARMR Insider, Gabe. Okay. This is an interesting question he asks. Michel's posting this for us. Thank you, Michel. Is there a reason we're more confident about precious metals in 2023 than 22? 22 would be a year of, he thought 22 would be a year of PMs and commodities. PMs are finicky or bear market overshadowed everything. Which is it? These are good questions, Gabe, really good questions. And I'm going to say two things. I'll keep it brief, and we're going to delve into more of this next week with the Silver Fox. Oh, there's Newmont Mining. We're killing it in Newmont Mining as well. Couple answers to the question. It's a great question. Why are we more confident now than in 2022? Why is now the year versus 22? And my first answer, Gabe, is to look at this chart and everything will be revealed to you. So we expected precious metals to be stronger last year. We thought commodities would be stronger last year. The only commodity that was strong was energy. And the reason is because the US dollar had a historic run, something never before seen, I think, in history. I don't think that's hyperbole. Somebody can call me out on that if I'm wrong. The percentage move up in the dollar versus all currencies was never before seen. So whatever we expected to occur last year in commodities got delayed because the dollar went berserk. The dollar unwind is clearly happening now. The dollar's broken below the 200-day moving average. The 50 and 200-day are in a downtrend. If that continues, commodities can shine. Commodities are the reciprocal of the US dollar. So that's number one. It started in November. That's why we got long gold and silver in November. And it's accelerated as the dollar is broken down. If the dollar keeps breaking down, this is the year for commodities. That's my first answer. Number two, and we'll get more into this next week, but are you familiar? I don't know if you all are familiar with this. You can go do your own research on it. There are rules put into place called Basel III. I'm not going to get into a deep dive here because that's something Silver Fox and I'll go over next week. But Basel III was supposed to go into effect in 2022, and it got delayed a year. And it went into effect January 1st of this year. And in essence, what it says is gold can be held on bank balance sheets as a tier 1 asset to be matched against liabilities and matched against, what's the word I'm looking for? Banks have a certain amount of capital reserves, reserve requirements, right? They have reserve requirements, certain percentage. Okay? They have reserve requirements. They can hold those reserves in only tier 1 assets to be compliant. Tier 1 assets have been things like US treasuries. That's primarily what a tier 1 asset is. Gold is now a tier 1 asset, sitting right next to US treasuries on bank balance sheets to shore up their reserves. That is the single biggest difference between gold and Bitcoin. Bitcoin is never going to be a tier 1 asset. Bitcoin's a risk-on asset. I don't want to get on that, but I'm just saying it's so clear in that conversation. People talk about debt ceilings and issues with too much debt and too much spending and all these things. If you just think about it for a second, and the logic of this is so clear, Central banks hold a lot of gold. The U.S. does. China's been buying gold like crazy. You have an asset on the balance sheet of the United States of America, right? The bank, Fort Knox, carried at a certain price to match against liabilities of this country. We have a huge deficit. If the price of gold elevates, it has a very sweet and unique way of balancing the books. Basel III put into effect gold as a tier 1 asset. Central banks have been buying gold like crazy. Just go back and look at the data. The time to release gold and let it go up in value to help mitigate the profligate spending is now, and it's happening. And if you don't believe that it's happening, you don't have to believe me. Just look at the chart. Look at the chart of gold. Look at the weekly chart of gold. It's accelerating out of a base. And so I would say to you, Gabe, I would have thought it was going to happen last year, and then the US dollar went berserk, and they delayed Basel III implementation until January 1 of this year. So that's just pushed it out for a year. Now we're here, and in the last week of last year and the first 2 weeks of this year, gold is accelerating higher. Is that just coincidence? So these are the reasons why. These are the reasons why I think this year is the year for commodities, right? It's really the breakdown in the dollar. And it's the year for precious metals. Will a bear market ruin it? It depends on the type of bear market we have. So if the dollar skyrockets in value again and risk assets get crushed, gold and silver are going down with it. They may go down less because now it's a tier 1 asset and central banks are buying gold. So it may go down less, but they're all going to go down. Like in a bear market, we get 100% correlation. Everything implodes if the dollar is skyrocketing. I don't know. If we have a different type of bear market where the dollar is imploding, gold and silver might go through the roof. It's the right asset to own in this market. The reward to risk is right. We put the capital to work in November, and we're just enjoying the fruits of our labor. And what we do now is just manage our risk. You know, on our live trading desk, and you guys can subscribe and join us on the desk all day, there are certain days where we're buying dust to hedge our mining positions, or we're short the mining stocks to hedge our risk on an intraday basis. That's how we manage our risk. But we're not touching our investments this year. We have a nice stop. We bought them right. We have our stops in place, which are not tight. We're not tight. We're letting them trade. We're going to use intraday tools to hedge correctly. And we're going to see where we end up this year. So we're not going to force our will on the market. If things change, we'll change with it. But right now, we have the bit in our teeth. We bought them right, and they're running. Mo, it's so funny. I was looking at this Festeroso. I was looking at building my dividend portfolio. I almost did it Friday, and then I just stopped and I hesitated. I said, I'm not going to do it right now. So in June of last year, the ARMR dividend portfolio went to 100% U.S. Treasury bills. Why not? I can get almost 4.5% risk-free in a Treasury bill. It's hard to buy a dividend stock. I certainly wouldn't buy a dividend stock pays less than 4.5% because my dividend portfolio is as conservative as I can get. So in a difficult market, I'd rather just collect interest at 4.5%. But I am looking at some investments. Altria is not at the top of my list, but it's not a bad pattern either. I think AMLP is at the top of my list, right? The pipelines. I could see myself getting in the pipelines. I'm really interested in this stock right here. ARMR Insider brought this idea to me, and I really like this idea. JP Morgan Equity. And what they do is they write calls and give you an increased yield, an enhanced yield. It's a really interesting idea to me. If the market actually breaks out, I could put this position on. It owns a whole bunch of conservative big cap stocks, and they write calls on it and collect, a yield to go along with dividends. That's an interesting idea. So I'm looking into that. So that's kind of where I'm headed. Not really so much MO. And here's Mo. Hey, hey Mo, how you doing? I'm not going to get mad at you ever. Gives green or buy signals after the move already happened and too late to act. Well, that's actually not true, Mo. If you've been on the desk and executed with us last year, the risk monitor went green twice, and somebody following the risk monitor made money last year, right? So feel free to reach out to me. We can go over what those models are and how they execute. So I'm not mad at all. It's just a question of understanding how to use the information that's being applied. Okay, so feel free to reach out to me, and I'm more than happy to go over it with you. No worries. I mean, Mo and I have chatted for years about this stuff, so happy to go over it with you in greater detail, Michelle. And we could just look at, for instance, let's look at the S&P. Okay, so these green bars are where the risk monitor is starting to go green. So the risk monitor last year picked off the market right here, and we captured that whole rally, Mo. Right? So the risk monitor this strategy got green right here and reversed got right out there. That's the red bar, right? So we're buying right off the low there, right? And then right here we got long, and we ended up getting out right there. So the risk monitor catches us when we can near the lows, but the monitor is about identifying, looking at 7 indexes, flows of institutional capital. Last year was a real tough year, and the risk monitor still delivered. So feel free to reach out, Mo, and we'll go over how to use it. EXAS. Exact Sciences. Is it too late to sell a covered call 2 weeks out? I really can't answer that question. I don't know what your position is, or, I don't know why it would ever be too late to sell a covered call. If you own it cheaper and the stock's gone up a lot and you could sell a call to bring in premium, it's never too late to do that. If the stock runs away, they call the stock away from you. You collected the premium and you made whatever money you made. So when you sell a covered call, it's actually the most conservative way to use options. The purpose of selling it, you buy an asset, it goes up, you sell a call, or you buy an asset and sell the call immediately. You're bringing premium in. If the price goes down, you still have the stock and you get to keep the premium, right? If the price goes up, you keep the premium, but the stock gets called away. Hang on a second. I got a sneeze coming. I'll put it on mute if it hits it. Oh, it's a tickle. All right. So not exactly sure how to answer that question. Is it too late? I don't know exactly what you mean there. All right. Can you please explain ticker AG? Who doesn't want it overnight? AG, Chad, how you doing, man? AG is lagging behind. As you can see, it's still below the 200-day moving average in here. Now, what I own, Chad, is SILJ. That's how I'm getting my silver coverage. And so due to the fact that I am, the risk monitor is yellow, so we're still conservative. We're not putting all of our capital to work. The other thing that means to me, risk monitor yellow, means I'd rather focus on group ETFs than take individual stock risk. That's a key differentiator. In a risk monitor green, I'm running out there, I'll buy individual stocks. But it's a dangerous market. I want liquidity. I don't want to get trapped in the one name that's underperforming. There's also, from a precious metals point of view, a weird thing going on around the world where certain countries are nationalizing mines or extorting the company doing the mining, saying, hey, I know we agreed to this royalty rate, but now you got to pay us more on top of it. I think there was a mine, was it in Peru recently? A Canadian company said, all right, well, we're not going to mine them. We're going to put the mine into, maintenance and not pull anything out of the ground until we figure this out. So you got to be very careful when you're buying individual stocks in the mining space that you're not buying a name that has too much exposure to the wrong country that's going in the wrong direction when it comes to rule of law. And so for my money, I'm most comfortable just, boom, going into the mining ETFs, getting a broad group of ETFs. I also think at this stage in the cycle, the alpha is going to come from owning the group. Later in the cycle, the alpha will come from the best names in the group. I might, when this rips higher, I might book some profits on the ETFs and then make my way into some individual names if I'm more comfortable. But in the world we're in today, I'm just not, I'm not that comfortable buying individual names. But having said all that, Chad, I couldn't agree with you more. If this thing can break above the 200 days, so what is that, like $9? What is that? 906, right? So it popped above 906. If it can close there, and honestly, what you want, Chad, is a weekly chart pattern. So you'd like to see it, take out these highs on a weekly level. So not a bad looking pattern. Mo, what do you got for me? Oh yeah, NTR, nutrient, okay, and MOS, and this goes along with the move theory. I don't like these patterns. I just don't like these patterns. So I'm not there. I'm not getting the same setup in agricultural investments as I am in other, commodities like, gold, silver, copper, energy, those types of things. It's just not the right pattern right here. What was I going to look at? I was going to look at something else, but it slipped my mind. Hey, nice to see you, my friend. Yeah, great start to the year. Oh, yeah, let's don't forget taking a look at platinum. Well, they're all commodities. Precious metals are commodities, Stephen. So they're precious. I would consider this a precious metal. I think I don't know. But what difference does it make? I mean, it's a commodity move. Instead of getting lost in the weeds of what we want to call it, these assets go up when the US dollar is going down. And the unique situation in the platinum market that Ares has been enlightening us on makes platinum a very interesting investment. It could have a really big move. It's a small market with some really interesting fundamentals unfolding. You can see the long-term downtrend broke here. That's step one. Then we break out of that pennant, step two, and we're looking for that to accelerate. All right. Guys, this has been a pleasure. Sorry to say that Pop was out. I hope he's, feeling a lot better soon, and we'll get on this together. Again, we'll do this redux next Saturday with the Silver Fox, drilling down into the precious metals discussion in a deeper way. I appreciate you all spending your time with me today on a Saturday. Enjoy Wild Card Saturday. I know I'll be watching some football, and you all have a great weekend, a great long weekend. I'll see ARMR Insiders 8:30 Tuesday morning. If you'd like to join us, ARMR Report right there, ARMRreport.com. Feel free to subscribe to our weekly free email where we give you updates on how our portfolios are structured, what the risk monitor looks like, all those things. So that's the ARMRreport.com, ARMRreport.com. And I'll see you all next week.